On an S corporation return, not everything gets lumped into ordinary business income. Ordinary income is basically the business profit from operations. But certain items must be broken out separately because they keep their character when they hit the shareholder's return. On the EA exam, they love asking which items are separately stated versus included in ordinary income. Allocation is pro rata. That means income, deductions, credits, and separately stated items flow through based on ownership percentage. Even if no cash is paid out, if you own 30% all year, you generally pick up 30% of each K through 1 item. A classic trap. No distribution, so no tax. Wrong. You can owe tax with zero cash. Here are the big, separately stated buckets to recognize. Rental real estate income or loss, portfolio items like interest and dividends, capital gains and losses, Section 1231 gains and losses, charitable contributions, and Section 179. Also, watch for credits, foreign taxes, investment interest expense, and AMT preference items. Another quick exam point, S-Corp don't get the dividends received deduction. Use this mental check with a fact pattern. If the corporation has gross receipts and pays wages, that wage expense reduces ordinary business income. But charitable contributions, rental losses, and capital gains do not change ordinary income on the 1120S. They show up separately on Schedule K and each shareholder's Kth run because the shareholder needs the character to apply their own limits. Now, distributions. First, remember the order of operations conceptually. Shareholders are taxed on pass-through income, whether or not distributions happen. Distributions are a separate event, and the taxability depends on the shareholder's stock basis. And here's a governance rule they test. Distributions must be made pro rata to ownership on the same date to avoid creating a second class of stock problem. Property distributions get weird fast. The distribution amount to the shareholder is cash plus the property's fair market value. If the S-Corp distributes appreciated property, the corporation recognizes gain as if it sold the property at FMV. That gain flows through and increases shareholder basis. But there's a harsh rule. If the property is worth less than basis, no loss is recognized. Gains yes, losses no. The amount of a shareholder's stock basis in an S-corporation is very important. Whose responsibility is it to track a shareholder's stock basis? The choices include the shareholder, the S-corporation through annual reports, a company officer quarterly, or the S-corporation by reporting basis on Schedule K through 1. Think about it. The correct answer is, each shareholder is responsible for tracking their own stock basis. The K1 reports income, deductions, and distributions, but it does not maintain your basis for you. A tempting wrong answer is the idea that the S-Corp reports basis on the K1 every year, because basis is personal and depends on the shareholder's own history. Ethan is the sole shareholder of an S-corporation that has no profits this year. His stock basis is 0 at year-end. On December 31st, he receives a non-dividend distribution of $400 to $500, which is more than his basis. How is this treated on Ethan's return? The options include ordinary income, short-term capital gain, compensation, or long-term capital gain. Think about it. The correct answer is long-term capital gain of $4,500. A non-dividend distribution is tax-free only up to stock basis. Once basis hits 0, the excess is capital gain. And because Ethan has held the stock for more than 1 year, 3 years here, the gain is long-term. The tempting wrong answer is ordinary income, but distributions don't become ordinary just because basis is 0.